And welcome to this latest episode of the Bull and the Bear podcast. I'm your host and market research analyst, rather, for Money and Markets, Matt Clark. Glad you're joining us. Just run through real briefly in case you aren't aware. If you are listening to us via podcast, that's great. Make sure you follow us. Leave us a rating if you'd like. You can also leave us a comment. Make sure you click notifications and get alerted every time the podcast gets released. That way you kind of get that information ahead of time, because we usually release our podcasts or videos about a day before they come out on moneyandmarkets.com. Podcast is also on YouTube. Just go to youtube.com, type in The Bull and the Bear, and you'll actually type in Money and Markets, and you'll see our green logo right there, and just click on that. Subscribe to our channel. That way you can kind of follow us along. And there's also the option to, I think there's a little bell that comes up that you can get notifications. If you do that, then you'll also get notified every time we put out a new video. So that's always a good practice to have, just so you get information first. If you have any comments or questions, or maybe there's a sector or stock you'd like us to look at, don't forget to email us at thebullandbear@moneyandmarkets.com. That's thebullandbear@moneyandmarkets.com. Subscribe to the channel. Subscribe to us on podcasts. We're on about 20 different podcast syndicators, so you can't go wrong. You can't miss us. We're in the process of getting onto Amazon as well, so you'll soon be able to listen to us on your Alexa connected speakers and devices. So that'll be a good thing to get rolling. So without further ado, let's jump into today. And it's a sector that gets a lot of attention, but gets a lot of attention in other ways. When you think of things like real estate, most people will equivalent that to home buying a house, renting a house, buying property, things like that. But as investors, the real estate market is much broader than that. It's not just about homes. It's not just about construction. It's about a lot of things. And in fact, that sector has grown exponentially in terms of what it offers over the last at least 2 decades. You've got real estate investment trusts, or REITs, property managers, storage companies. All these are now part of the real estate investing world. If you take a look at the S&P 500 Real Estate Select Spider ETF, it's an exchange traded fund that tracks some of the bigger real estate companies on the market. It's jumped about 43% since reaching a low in March of 2020. It's still about 13.5% off of its previous high set back in February. The actual ETF itself covers companies ranging from cell tower owners, American Tower Corporation, Crown Castle International Corporation, to a real estate investment trust, Prologis, which does logistic facilities in last mile logistics. They basically have last mile warehouses for companies like Amazon, Apple, things like that, to put their goods before they transport it to the final destination, which is you and I, the consumer. Now, the ETF itself reached a death cross where its 200-day moving average crossed above its 50-day moving average. But now it's very close to doing the opposite and hitting a golden cross, which is where the 50-day average moves above the 200-day moving average, and it's starting to move upwards. That golden cross sometimes indicates some short-term momentum. Sometimes it works. Oftentimes it does, but there are instances where it doesn't. But what I want to do today is I want to bring in Money and Markets Chief Investment Strategist Adam O'Dell, as well as contributor Charles Sizemore, and I want to talk about 3 real estate sector stocks and kind of get your feel of your thoughts on them and talk about them kind of at depth. And I'll start with a company that is a real estate investment trust. These have become very popular investment drivers of late because of some of the benefits they provide in terms of reinvesting 90% of their income back into to investors and things of that nature. This is a REIT that specializes in data centers. So if you see data centers, Facebook has big data centers, AT&T has them, Apple has them. They're located all over the world. And what they are is they're basically data storage areas where these massive, not even terabytes, even more than that, get stored in these big rooms full of nothing but just computer storage areas. This one operates in 55 markets. It's got, and that's across 5 continents. So it's got a really big footprint. It's got a market cap of about $70 billion. Its 3-year annual sales growth rate is 15.2%. Its 3-year annual EPS growth rate is 50.5%. So it hit a low of about $4.85 a share back in March of 2020. It has ticked up now, well, more than ticked up. It has rebounded strongly, about 62% from that low to around $7.86 a share. The company that I'm referring to first is Equinix Incorporated. It trades on the Nasdaq under EQIX. That's EQIX, Equinix Incorporated. And first, I'll toss it to Charles Sizemore. And Charles, give me your thoughts on Equinix.
Yeah, well, first, more broadly, I love REITs, and I know you shouldn't love your investments because they're never going to love you back. You should be a lot more cold and rational than that. But if I were, and you shouldn't marry your investments because the situation changes. You should not tie yourself to one investment theme. But if I were going to marry an asset class, it would definitely be REITs. I think they're one of the more future-proof areas of the market. Now, that's of course less true in this age of COVID. A lot of real estate that we might have thought was future-proof is proving to be anything but. But moving on to this company in particular, I love the company. I'm not so in love with the stock, and I'll explain that. The data center trend is one that is not going away anytime soon. At the rise of cloud computing, that's only going to get bigger. And part of it is geography. If you're a big Silicon Valley company based in, well, Silicon Valley, that's redundant, but if you're based in California there, you can't have all of your servers there. There are risks. There's it's an earthquake zone. Furthermore, you want the data crunching to be closer to the end users. So you want data centers spread out across the country to be closer to the people using them. This trend is not going anywhere anytime soon. This is only going to get bigger. I love the sector, love the stock, love the company, love management, love it all. What I don't love is the price. This has gotten a bit bubbly. In the last 2 years, the stock has more than doubled. That's unusual for a REIT of any size. This is not some internet startup. This is, at the end of the day, a real estate investment trust. They're just not supposed to be that volatile. It also has a very middling, well, I can't even say middling. It's actually just low dividend yield. Dividend yield is less than 2%. So REITs are first and foremost an income play. They're a total return play because you're not just looking for income. You're looking for long-term capital gains as well. You're also looking for an increase in the dividend over time. You're looking for companies that raise the dividend. That's one of the reasons I love the sector. It's inflation-proof because as inflation rises, so do your rents. It's all these things are great. But at the end of the day, price is what matters. And this stock is just a little too expensive right now.
All right, and now I'll bring in Chief Investment Strategist Adam O'Dell. And Adam, I think he brings up a good point in terms of the overall price. But aside from that, Equinix actually scores fairly well on your Green Zone rating system. Talk a little bit about that and give us your thoughts on Equinix.
Yes, it does, Matt. It scores above average. It scores about a 63 out of 100. So that does put it within the realm of consideration, kind of a more bullish stock. But it's not a true green zone stock. It doesn't have a score of 80 or 90. I'm going to have to pass on Equinix right now. What it does have going for it is momentum, low volatility. I mean, the uptrend over the past 2 years has actually been a steady march, even though it's in percentage terms quite high. It hasn't been a volatile uptrend. It's been a very smooth one. So it gets high scores in the 80s and 90s on momentum, on low volatility, and on growth. But that said, it's kind of a dichotomy. It gets really poor scores on quality. It gets a poor score on size because it's a rather large company. It's about $69 billion. And its lowest score, as Charles kind of alluded to, is in the value. It scores a 6 out of 100. So basically 94% of the entire market is valued more cheaply than Equinix right now. So I think it has a PE of like 133 or 136, forward PE of 95, a price to sales of over 12, price to book of about 7. So no matter how you look at valuation metrics, it is very overpriced at this point. Not just overpriced, but grossly overpriced. And as Charles mentioned, the dividend yield really doesn't justify something like that. I mean, often when you can get a yield in the 5 to 10% range, that's considered high yield. But 1.33%, which is the current yield on this REIT is just is not that great. I mean, one of the problems with the treasury bond market with, treasuries, the price of bonds going up so much over the past several years and the yields going down so low. I mean, the 10 years trading at like 60 basis points right now, 65 basis points, which is about 0.65%. Is that, investors that are traditionally looking to treasuries for yield, income-oriented investors, they've had to go, it's been called, the search for yield. They have to go farther out onto the risk curve, meaning rather than investing in safe treasury bonds, which used to pay anywhere 3, 4, 5, 6, 7, 8%, they're now having to go to REITs and to dividend-paying stocks and investments that are farther out on the risk curve. So, I think that probably what's contributed to the bid up in the price of Equinix is that over the past several years, the T-bond yields have just been plummeting. And so people have gotten into REITs thinking, oh, well, they're probably almost just as safe as T-bonds, and they're paying, maybe twice the yield. So that's what I think a lot of people are doing as far as the reach for yield. And eventually it's going to come out and bite people in the butt. So for now, even though it gets a decent score in the 60s, I'm a pass on this one.
And I am too. And the biggest thing is that you guys have all brought up all the strong reasons why. I mean, it says it's not a bad company. It's got good management. It's in a good sector. But right now, the price is inflated. That's the first concern. The other concern I have is $15.4 billion in debt compared to only about $4 billion in cash. That's a lot of debt. I know that their income structures, if they get money off of rent payments and things like that, I get that. But to have $15.5 billion in debt compared to $4.8 billion in cash is a bit of a concern for me as well. So I liked this company about a year and a half ago, but in terms of actual investment, this one, it's got to have a major pullback for me to be excited about it and really drop those ratios down to more in line with the industry, if not lower. So moving on to our second stock today. This is a company that owns and operates wireless communications infrastructure. They're spread out in North, Central, South America, as well as South Africa. They mainly focus on leasing antenna space on their various communication sites to wireless service providers under long-term lease contracts. So basically, your T-Mobile, your AT&T, your Vodafone, your Vodacom, places like that are leasing space from this company on their towers to put their equipment up to send you out your wireless signal. The company's stock hit a low of about 214 back in March, as did just about every other stock hitting a low back then. It's rallied about 45% since then. The company that that we have here on number 2 is SBA Communications Corporation. Trades on the Nasdaq as SBAC, so it's SBA Communications Corp. Trades on the Nasdaq as SBAC. And first, I'll throw it to Charles. Charles, your thoughts on SBA Communications?
Sure. Before I address that, let's go backwards just 1 second. You'd mentioned the debt on Equinix. I would say maybe be open-minded on that. Real estate investment trusts in general tend to have a lot of debt because real estate in general has a lot of debt. Banks love to make loans backed by real estate. And in the case of the tenants paying the rent, they're all major corporations with their data and their computer equipment in the building. They're going to make that rent check if it kills them. So I would say, that stock was still a pass, but I would be a bit more open-minded on the debt. Now, looking at SBA Communications, it's kind of a similar story, really. I love the company. I love the sector. At the end of the day, do you envision a scenario where you're going to be using less data on your phone? I don't. I don't think that is a one-way street. We will be using more data on our phones until we're all dead. I mean, that's how that's going to go. And particularly with the rise of 5G, 5G requires more towers. So previous iterations, you could have relatively fewer larger towers. 5G requires smaller micro towers all over the place. So that does benefit, it benefits the landlords in this case. I would say within the space, I do like some of the competitors a little bit better. I would say I like Crown Castle and American Tower a little bit better. I'm not in love with the pricing on any of them. I would say, put a gun to my head, is this a stock that I would be comfortable buying and holding for years? I'd say, yeah, probably. I would prefer to get it at a cheaper price though. So I would say this is a soft pass for me right now. Love the company. Absolutely love the sector. Just fantastic long-term macro trend supporting all of this. I would just really like to get it at a dip.
Okay. And to your point about debt, I understand that. I get it. I get that having a large amount of debt in this kind of a field is natural, especially in real estate. My primary concern is the fact that the cash to debt is so wide.
Sure.
And I have an issue with that. I just, I don't necessarily think that debt is a bad thing. I just think to have that little amount of cash on hand compared to your debt, that's a problem for me. That's where my issue comes in. So you bring up a good point in terms of SBA. Adam, I'd like to hear your thoughts on SBA Communications.
I'm going to be a pass on SBA also. SBA scores a 52 out of 100 overall in my green zone ranking model. So right smack in the middle of average. It has basically the same footprint or fingerprint rather as Equinix in that it scores relatively highly on momentum, volatility, and growth, but very poorly on quality, value, and size. And what that tells me is that this is more of a trade than a good long-term investment, meaning that people have been hot on the sector. I mean, everything 5G has been kind of hyped for quite a while now. So people have been hyped on the sector. The search for yield, the reach for yield has been a longer multi-year trend. So I think this is a trade that's probably mostly run its course, or at least if you're just now getting in, it's probably not a good time to get in. Shares of SBAC went from like $100 in 2016 to $300 now. So we've already tripled in price. And that's why it gets a value score of like 3 out of 100. As far as the quality scores, I mean, these are REITs, so they do have a different capital structure, as Charles pointed out. So that's potentially why, I mean, my quality score of the 6 factors, one of them is based on quality. And some of the metrics that I look at within that quality score are based on debt. So debt to equity and the ability for the company to service that debt. But that quality score also looks at things like return on assets, return on invested capital, return on equity, profit margins, both gross margins, operating and net margins. And even on those metrics, and even more so than the debt, these two REITs have kind of scored subpar. So again, I think that this is a trade that's probably worked over the last several years, but I would not be buying into it right now.
Okay, and that's good. It's good you mentioned that. I was going to mention the net margin. Right now, it's about in the negative, 1% to the negative. The industry average is actually a 10%, 10.5% net margin, and actually SBA is running in the negative. And that's a concern. Is book value per share is about $37 to the red. To me, like I said, this might have been good about 2-3 years ago, but now I think it's overpriced. I think it's met its threshold. I would see probably a pretty good downtrend coming once investors start realizing that there's not a long-term potential with a company like SBA. All right, and now moving into our third and final one. I want to take a little bit different track here. We've talked about 2 REITs. We've talked about in a very hot data center sector and also in the communication towers sector. Here, I want to take I just want to go 180 degrees in another direction. This is a REIT. Interestingly enough, but you wouldn't know it as one. It specializes, it acquires and develops self-storage facilities. It's got about 2,500 self-storage facilities across 38 states. At last check, about 171 million net rentable square feet in the U.S. alone. It hit a low of $158 to $158 a share back in March. It's jumped about 34% since then, but it's still about 20% off its high that it set back in August of 2019. And this stock is public storage. You see their signs up and down main streets and in cities and towns everywhere where you just pull off and you can rent a storage locker, storage garage, whatever. But this company is actually a REIT. And they trade on the New York Stock Exchange as PSA. That's P as in Paul, S-A. And I'll first send it over to Charles. And Charles, you've had some time to look at this. What do you think about public storage?
I actually like this one, and it's for a couple reasons. One, if you're a landlord, the nightmare property to own is something like a nice hotel or a nice office building. And that was even before COVID. And the reason is you got to keep the office. I mean, the maintenance on an office building is just, it'll bankrupt you. I mean, everyone, if you're going to do business in a building, you expect it to look pristine at all times. Same with a high-end apartment building. Same with the really high-end retail building. Appearance matters. Something like public storage, it's a warehouse. It's a little storage locker. I mean, there's really no maintenance to do on a property like this, which makes this subsector of real estate very attractive to me. It's cheap to maintain. There's not going to be these big expenses coming down the pipeline. Looking at the big picture of the sector, it did get a little bit overbuilt a few years ago. This sector was extremely popular, I would say, maybe the last 3 or 4 years of the Obama administration. It was like, this was almost like a trendy sector. And then it's sort of peaked out and it's been going sideways for a while. Part of that's just there was a little too much inventory in it and it had to be absorbed. Now, of course, public storage is one of the absolute biggest and best run in the space. So that's, a little bit of a shakeout isn't such a bad thing for them. Looking sort of more macro, recessions are good for this space. This is an anti-recessionary sector, and the reason I say that is just sort of think through it. If you lost your job, you've lost your house, you've lost your apartment, you're having to move back in and live on your mother's couch for a while, or move in, whatever, go get a roommate. If you're having to downsize due to economic necessity, you got to have somewhere to put your stuff. And that's where public storage really comes in handy. When the economy is doing poorly, public storage and its competitors tend to do well operationally. Their recessions aren't bad for them. Looking at the yield, it's respectable. It's a little shy of 4%. It's not great for a REIT. I would say the sweet spot for a REIT yield these days is somewhere between 5 and 7%. You can get a high quality REIT yielding in that window. You get much higher than that, you're probably taking a bit more risk than you want to take. But this is sort of the lower. It's just kind of below what I would consider the sweet spot window, but it's not quite low enough to make me walk away. So I would say I like the company in general. I wouldn't necessarily be in a huge hurry to buy it today because it has been trending slightly lower for a while. I think if you were going to initiate a position here, you could average in over a few months. There's no sense of urgency. But I think it's a fantastic company, and I would be a buyer here.
Okay. Adam, what do you think about public storage?
I have a little bit different take. I guess longer term, I would look at this more as a shorter term trade than a longer term investment. I say that because I can't in good faith say that it's a great longer term investment. It scores a 30 out of 100 on my overall 6-factor green zone ranking model. Part of the reason it's getting dinged to be such a low score is that its momentum is rather low. So longer term, it's been in a downtrend for like the past 5 or so years, kind of trending down and then kind of carving out a bottom. More recently, that momentum started to tick up, but I look at longer term momentum as well. So the trend in momentum isn't wonderful. The size, it's still a larger company at 37 billion, so you're not going to get a small cap pop there. Its valuation is much better than these other two we talked about, but it's still at 30 at a PE of about 30. It's a bit overvalued. It does score highly on quality. So if you look at public storage's return on assets at 10%, return on equity 24%, invested capital at 21%, its gross margin is 71%, and its net profit margin is 42%. So it's actually a very high margin business, at least for public storage. But the reason I say that I think it's a better trade than a longer term investment is that it has been in this downtrend since 2016. It's kind of carved out a bottom. It made a lower low in March, but since then it has recovered some. It's trading above its 200-day moving average. It's in a positive trend according to my Cycle 9 6-month trend measure. And so I look at it as a high reward to risk trade in the sense that right now you can buy shares of PSA for around $210. It's about $212, but I think you can probably get it on a dip to $210. What I would do is I'd put a stop loss at $200, which is just below the 200-day moving average. So you're talking about a $10 per share stop loss. So if you get stopped out, you're going to lose $10 per share. But if this uptrend, this kind of bullish breakout and uptrend continues, you're looking to make about $60 if it rises back up to the 2019 high of about 265, 270. So that's basically a ratio of 6 to 1. So you have potential profits of $6 for every potential loss of $1. So that's an excellent ratio. I mean, if you can make that trade any day, you should. And so that's why I think that just based on the chart pattern alone and the fact that PSA, it is a good operating business. It's just kind of been out of favor for a while. But if we are kind of in a recession now, if there's been a moratorium on evictions, but if that changes in the near future, I certainly see that as a potential catalyst for PSA to kind of get a bid. So I would look at this as a kind of a shorter term trade if you can buy in at 210 and put a stop at 200 and see if we can get some upward momentum over the next few months.
Okay. Charles, you mentioned about how it's kind of a recession-proof stock, and I'm not disagreeing with you, but I'm going to tell a little bit of a different story. Whenever you are maybe have to move out or consolidate or whatever, a lot of times I think when people look at consolidation, they look at consolidation of expenses. And if one of your expenses is a storage facility, then maybe one of those things you look at is getting rid of the storage facility because that's a recurring monthly rate. If that means you're getting rid of stuff, you're getting rid of stuff. I'm not saying that's the norm. I'm not saying that's an everyday thing. I'm just saying that I think that's a different story to tell.
Now, Matt, that's how I think. Now, personally, I would rather burn my belongings than pay to store them somewhere. I mean,
and I'm the same way.
I'm an anti-pack rat. I mean, I'm happy to live in a completely sterile room with like no pictures on the wall and sit on the floor. I'm and my wife's the same way. Like we're basically minimalist, but most people aren't like that. Right. America is a land of hoarders, and when you out hoard your house, you have to expand new frontiers for your hoarding.
Right. I'm a pass on this as well. The biggest concern I have is how it's traded sideways. It's broken up a little bit. I see it's ticking up a little bit, but I'm just not too sure how long its uptrend will last. Obviously, you want it to last a long time if you're going to invest in it. I think maybe short term it's a possibility because, like Adam said, a 6-to-1 ratio with gaining $6 to every $1 you lose with a stop loss of $200. I think that's a great idea. I would just be very hesitant about public storage at this point. So those are 3 stocks talking about the real estate sector. I want to thank Money and Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore for joining me as they do each and every end of the week. We do have the Labor Day holiday coming up on Monday. That the markets are closed, so take a day off, spend some time with your family. Charles, we have to congratulate as he has an addition to his family that just came last week. So congratulations to him on that. I won't go into too many details, but it's great news and congratulations to you. And I certainly hope both of you guys get time to spend time with your families. I know it's been very, very busy over the last couple of weeks. And I hope everyone out there enjoys the Labor Day holiday if you're lucky enough to be able to have that extra day off. Again, you can listen to the Bull and Bear podcast on any podcast syndicator out there just about. We're in the process of getting added to Amazon as well, so that'll be a nice change. Nice addition for us. Plus, you can watch the Bull and the Bear podcast on YouTube. Wherever you're listening, however you're listening, make sure you're following us. Make sure you get notified every time we do put out a new podcast, because we do put out podcasts and videos about a day or so before they actually come out on moneyandmarkets.com. And that said, don't forget to check Money and Markets each and every day for safe and profitable advice and information, investment information for you. So for Adam O'Dell and Charles Sizemore, I'm Matt Clark. I certainly hope everyone has a great weekend, enjoys the Labor Day, and we will talk again next week. Until then, safe trading, everybody.